community focused on providing a platform to foster personal and professional growth and development and connections for women and allies in the business, in tech, and beyond. And we're so proud to share with you that we've actually extended this community to over 1,400 people in business and tech now. And if you want to know more about the community, you can join our LinkedIn or our meetup group, or you can reach out to us after the event as well. Right. Just as we begin, I wish to acknowledge the traditional custodians of these lands on which we virtually meet today, recognizing their continuing connection to land, waters, and community. And I pay my respects to them and their cultures and to elders past, present, and emerging. I'm joining from Sydney today, like a lot of you, so I would like to acknowledge the Gadigal of the Eora Nation. Now, we know some of you may be new to the Google Meet interface, so let's just take a quick minute or so to give you a quick tour of the Google Meet platform and how you can navigate it, and just a bit of housekeeping. You'll see a microphone and video icon right at the bottom. This is what you can use to unmute or mute yourself and switch camera on or off. If you can please ask everyone to keep yourselves mute during the presentation, that would be awesome. And please don't worry, we'll have loads of time for Q&A. And that's when you can unmute yourself and ask your question. You also have the option to turn on captions, which you can see on the bottom here as the CC button, so feel free to use. You will notice these three dots. You can click on them and you can change the layout if you'd like to see more people on your screen. Or if you would like to pin a specific person, the speaker, or the presentation, you can just hover your mouse over their icon and just click on the pin button. Today, as you can already see, we will be using the chat function quite extensively to interact and engage during this session, and it'll be the main way for us to ask our speakers any questions that we have. Before we move on, any questions on Google Meet and how to use it? All right, I'll take the silence as a no. Introducing myself as well, my name is Radhika. I'm an account manager here at Google and also part of the Connected Women team. Big shout to our core Connected Women team at Google who's helped organize this session. Katie, Melissa, Karen, Mia, Surabhi, and Adeline. And without further ado, I will now introduce our speakers for today. We have Betsy Westcott and Molly Benjamin joining us. Betsy is a Ladies Finance Club ambassador and financial educator. Over the past 12 years, Betsy has worked both as a bank manager and then later as a private banker to Australia's wealthiest families and individuals. Gives me a lot of confidence on what we're going to learn from her today. She's qualified both as a financial advisor and a mortgage broker. And more recently, she helped launch a digital startup bank and was responsible for Australia's first ever retail equity crowdfund campaign. Not going to lie, a lot of words I don't understand, but I do hope to understand them by the end of this session. And today, Betsy is the Chief Revenue Officer of a financial wellness fintech that empowers customers with flexible cash flow choices. Betsy's passion is improving the financial lives of others and advocating for financial well-being. And that honestly makes her the best speaker we can have for a Money Makeover session. We also have Molly Benjamin. Molly is the Ladies Finance Club Australia founder and financial educator. She also founded the Ladies Finance Club UK and is on a mission to empower women to take control of their financial future and transform their relationship with money. We try and avoid the boring bits here, and wherever possible, we love to have a glass of Prosecco in our hand while we're talking money. Ladies Finance Club has had over 10,000 women attend their events, courses, webinar, corporate workshops in Australia, Singapore, and UK. So definitely a large reach, and have hundreds of members across Australia and UK in their club. So join Ladies Finance Club and you can get more money savvy. So I'd love to hand it over to Molly and Betsy now to tell us a bit more about Ladies Finance Club and kick off our Money Makeover session. Over to you.
Fantastic. Well, thank you so much for having us. We're really excited to be here and, give you a little bit of a money makeover. Now, we have got kind of 7 different sections we're going to cover today, but we just wanted to give you a taster of the things that we think are really important for you to know. So as we kick off, we just wanted to let you know that please note that this is general education and information. It is not advice. There is our disclaimer there. Please seek independent financial advice before making any big decisions. So again, this is just education, not advice. So, as mentioned, thank you for the kind introductions. Ladies Finance Club we're a club, we're a membership, we have courses, events, and we've got a bunch of events coming up in September, which you're more than welcome to check out and attend. We've got loads of free content all for you. So Ladies Finance Club is a safe space where women can come together and take control of their financial futures and get money savvy without the boring bits, because let's face it, dealing with money can, be a little bit dull sometimes. And the world of finance can seem we call it male, pale, stale, and blue. So we are here to mix things up. So without further ado, I'm very happy to hand over to the wonderful Betsy Westcott. I'll be managing the Q&A. So if you do have any questions, pop them in the chat. I'll either ask them to Betsy straight away, or otherwise, if I know the answer's coming up later, I'll hold off. I can just see a question coming up saying, will this presentation be sent to us? So you'll get a recording of the video, and you've also got a workbook where heaps of the content is in there as well. All right, so please put your questions in the chat. We'll get to as many as we can, and very excited to hand over to the lovely Betsy.
Thank you, Molly, and hello, everyone. I am so excited by just the sheer number of you that have set aside an hour today to spend with us and to prioritize your financial well-being. I have to tell you, ladies, it is my favorite form of self-care. It really does, pay it forward. So I'm really glad that you're doing this today. I feel like gold star to all of you. If you can't have a cheeky Prosecco now, you should definitely have one later for turning up for this today. So we're going to start with a little bit of an interaction. Pop your number on the chat, but how would you describe the way you currently manage your money? Are we a 1, is bad, send help. 2, save some, spend the rest. 3, it's kind of going okay. 4, we're getting pretty good at this. Or 5, I am the money queen or king. Mostly queens here today, I'm saying. Oh, look at all those numbers coming in. Excellent. Some strong. I like it when there's like a half. That's good. Covering bases. Oh, fantastic. Excellent. Oh, well, I can see there's definitely some good foundations around money management. As Molly said today, this is kind of like a bit of a taste tester, really setting the foundations, because I know there's some more workshops coming up where we're going to really dive into some juicy topics, such as learning how to invest and so on. So today is really just to whet your appetite, ladies, and get you really excited about money so that we can dive into the more detail. Now, why women? Why money? Why did Molly start Ladies Finance Club? And really, it's because, unfortunately, for us girls, we face a unique set of challenges when it comes to achieving financial security and well-being. So you guys probably can't see, but I am 6 months pregnant, so we'll soon be doing this number one, which is taking out some time from my career to care for family, both young and old. Oh, thanks, ladies. I'm really excited too, my first one. But also, we face a gender pay gap, and sadly, it's still persisting at 14% despite all of our efforts. So there's that to contend with. And we're actually more likely to work part-time, often because of those caring responsibilities, which means we're not contributing as much superannuation as we could be if we were working full-time. So how that compounds is that when we go to retire, on average, we retire with half the savings as men, which is problematic, not only because we don't have as much to spend, but it's problematic because we live on average for 5 years longer and our medical expenses tend to be higher. So it means that we've got a smaller pool of money and we're trying to stretch it out further. It's stacked against us a bit, if we just put it frankly. But the thing is, there's much we can do, particularly if you get started today, to really make a big difference to the financial outcomes that you can achieve and overcome many of these challenges. And this is why I'm so passionate about it, because I know I've got lived experience both for myself, but specifically for my mom, where I've observed the difference having good financial habits can make on your life. So to share a little bit of a personal story with you, my mum and my dad separated when I was about 6 years old, and mum, moved with my brothers and I to North Queensland, and she had to go back to work, and she was a nurse, so back to work, 3 little kids, and as wonderful as the work that our nurses do, unfortunately, as you know, they're not remunerated a whole heap. But what my mum did have was good money habits. And what that meant is that, despite not having a huge income, she was able to put practices in place that enabled her to buy and pay off her own home, always own her car outright and pay cash for it, and put money away into super. She'd go to all the seminars and learn, how should she be investing and what should she be contributing. And that meant that at 65, she could retire, not with a huge swag of money, I'll be honest, but with enough to see out her days, which, a lot of her friends who were doctors and surgeons weren't able to do because they didn't have those really healthy money habits and hadn't kind of planned for their future. So it's really not about what you earn, ladies, it's all about what you do with it. And one of the best places to start when it comes to prioritizing your financial well-being is figuring out, what do you want? I think that's a great question to ask yourself today, because, income and money and investing, they are not the goal. What the goal is creating and designing a life that you love. So the first place we always start at Ladies Finance Club is getting really clear on what is it that you want to achieve and writing it down. I can't remember the source right now, having a little bit of a moment, but I know it's 42% is how much you improve your chance of achieving a goal simply by writing it down. So to write down a really effective money goal, first identify, when do you want to achieve this goal? Is it in the short term, in the next 0 to 3 years, medium term, 4 to 6 years, or something that's a bit longer term for 7+ years? So we've got some little examples of how to write a really effective money goal. I actually coincidentally posted about this very thing on my Instagram this morning, the difference between crappy and winning money goals. And the difference is being really specific around what it is you want to achieve, by when you want to achieve it, and how much is it going to cost you to do? Like what's the financial element? So we've got a few examples here. You want to build an emergency fund up to $10,000 by June 2022. You might then start by putting aside $155 to be able to achieve that on time. Medium-term goal might be saving for a home. Long-term goal might be, retiring with that, $1 million+ super fund balance. What is really great about doing this is that once you know what and when and how much, you can actually really easily work out what is it going to take to get you there, what's the strategy, and it really becomes paint by numbers as to what you need to save or invest in order to facilitate that goal. Now, I'm going to give you a little spoiler for something that you'll talk about in the investing workshop, but short-term goals, we don't invest money in order to achieve the short-term goals. You always save for them. So hot, sneaky, spoiler alert tip for this one. Now, sometimes we set goals and, they don't turn out the way that we expected, and there can be reasons for this. Sometimes we set unrealistic goals. I've been working with clients who, say to me and who don't have an existing savings habit, and they're like, I would like to buy a 2-bedroom apartment in Sydney next year. And I was like, okay, so, you're probably going to need about $200,000 as a deposit for that. Where are we now with savings and what's our income? And it's not realistic to be able to save that much money in that time. So it could be a Goldilocks goal. Big one is your goals are too vague. I was working with a client on the weekend and her goal was to save money. I was like, well, that's a good goal. Let's see if we can get a little bit more specific. Like, what's it for? How much? When are you going to spend it? So getting really specific. Another one is they're not your goals. Is anyone, I don't know if there's any other people pleasers out there, guilty, where sometimes you adopt other people's goals and make them your own. And the problem with that is that they might not inspire you. Another client I was working with recently, kept telling me she wanted to save to buy a house. But when we were sort of like talking about it, I just really got the sense that she didn't really want to buy a house. It's just that she felt she should. And actually what she wanted was flexibility to, move around the world and then live in different places, which was completely in contrast with the money goal. So just really taking time to go, is this actually my goal? Is this what I feel like I should be doing? Giving up too early, you miss 100% of the shots you don't take. And also having no system in place to ensure that you're successful with your goals, because there's the goal, there's working out what to do, but then there's the actual executing. And are you setting yourself up for success? Or are you, making it really hard for yourself because you don't have any systems in place in order to achieve it? So today we are going to go through a bit of a checklist on how to be the Chief Financial Officer of your life, CFO. Yep, everybody's a CFO today. And we're going to go through setting up your emergency fund, creating a winning system for managing your money and how to set up your bank accounts to do that. Strategies to pay off bad debts, and actually just defining what is a bad debt. Some strategies for tax time and how to save money on tax legally. Very important. Taxman doesn't like it if you do dodgy things, so legally is always good. Ensuring you understand super. There's been some exciting changes to super this year, so we're going to talk about them. Cutting years off your mortgage and how to protect yourself against life's little curveballs, like global pandemics and such things. Okay, so dive in. So step number one, as the CFO of your life, is you want to make sure that you have an OMG fund. Oh my gosh, fund. Now, there's lots of different names that you can call your OMG fund. Some call it rainy day fund, the emergency fund. I've heard it be called the FR fund. You know what? Name it whatever you like. It's your money, but just make sure that you have one and that it inspires you. Now, this OMG fund, emergency fund, it's like the financial equivalent of your ride or die friend. So you know how you've always got that friend who's there with you to bail you out of a sticky situation. You just know that they've got your back. This bad boy is the financial equivalent of that. I have used mine so many times, from simple things like suddenly I had to replace the 4 tires on my car because I just forgot about that, and the mechanic was very disappointed and really gave me a talking to. But then there's been other times where, I found myself working in an environment that, just was pretty toxic and not right for me. And I was exhausted and I needed to find a new job, but I was so exhausted that I couldn't really bring myself to do interviews. So what my emergency fund allowed me to do was just resign. I had 6 months of living expenses. I was like, I can find a job within 6 months. And it was just a really great way for me to be able to prioritize myself and look after myself and not have to worry about what was going to happen financially. So the best thing to do is to set up a separate account, often maybe with a different bank, less so these days, but certainly younger Betsy couldn't be trusted with that very easy to transfer money into your spending account when it was like next to your emergency funds, especially at around 2 in the morning when we were all having a great time and, we obviously needed more shots at the bar. So if you're a little bit like drunk Betsy and can't be trusted, please set it up with a different bank account, make it a little bit tricky to get to. But set up a different bank account. Start by trying to save $1,000. One of the things that's really worried me during this pandemic is that 2 out of 3 Australian households can't find $500 in an emergency, according to research from CBA. And it just means that there's so much financial vulnerability out there. So if you can save $1,000, that is an amazing start. But what you want to work up to is having the equivalent of 3 to 6 months of living expenses set aside to get you out of a sticky situation. Okay. So we've touched on why setting up your bank accounts is really great for the OMG fund, and occasionally having them with a different bank where it's a little bit harder to get to. But we're also going to talk about how do you set up your bank accounts to ensure that you are on track with your financial goals? For many of us, we just have the one account, and from that one account, we've got to, pay the bills, keep some money for, going out and having a good time when we're permitted to, and, for your goals and stuff, plus your measurement. And it's all sloshing out in the one account, and you've got to perform this like mental gymnastics to keep a track of things. I don't know about you, but that reeks of effort to me. So what I do is I set up a number of different accounts for different purposes. Now, you can set up as many as you like, but as a rule of thumb, having 4 accounts is a really good base because they all serve a different purpose. So say you receive your income in every fortnight, month, weekly, whatever your pay cycle is, send the money that you need to pay for living expenses to one account. It's linked to a debit card. You set up all your direct debits, and that takes care of, the financially adulting stuff that we all have to do. Then you've got some money that you transfer to your fun money account. So this is the account where you can just have a good time, spend it on what you want, holidays, lunches, brunches, going out, whatever. My tip, though, is when the fun money runs out, you have to stop spending until next pay cycle. You can't go dipping in from the other accounts. And then you have an account for emergency funds. Once that's filled up, you can start working on those long-term goals and moving money into the goals account. So 4 accounts. Now, if you are like, how much should I be putting into this, and don't really want to go through your budget and figure out like what's my living expenses, what do I spend on fun, what's going to goals, you can just apply the 50-30-20 rule, which is just a rule of thumb that says, if 50% of your money that you earn goes to living expenses, 30% goes to funds, and 20% goes to the future or to your goals or long-term savings, like you're doing pretty well. It's a good rule of thumb. Of course, the best is actually like doing the math on what is your actual budget, but it's a helpful rule of thumb. Molly, I'm seeing some questions come through. Is there anything I should be answering right now?
There was a question just about how would you recommend splitting for emergency fund?
Yeah, so I really recommend building up your emergency fund first and then working on your goals, just because your emergency fund is that get out of jail free card, and having that safety net is so important. The goals we can get to, but we just want to make sure that if something happened tomorrow, that you're taken care of. So I recommend prioritizing emergency fund and then putting the money into the long-term goals. You can, of course, do both at the same time. It just means that you'll be a bit slower getting there. So, always decide what works for you. But yeah, for me, I always make sure my emergency fund's topped up and then go onto the goals.
And there was just one quick great question from Anisha, and I was literally doing this at 8:30 this morning. So she said, which account should I receive my monthly pay in? I always think a great thing to do is put it in your living expenses and then transfer out, or have your own separate bills account that then you can transfer out from that one account.
Yeah, perfect. And so typically your living expenses and fund money accounts are what we call transaction accounts. You've got a debit card linked to them, versus your emergency fund and future me. They're usually like savings accounts where you can earn a little bit of interest. And then, when you want to spend money of that, you transfer it out to either the fund money or the living expenses. But yeah, these are great questions. Someone's just asked about recommend any banks. I won't recommend any banks, but there was a good article in the Money Smart magazine recently, which I believe is available online, which reviewed the best bank accounts for transaction and savings. So have a look there. But what you want to be looking for is fee-free bank accounts, those cheeky fees. No one wants to pay a bank fee. Ugh, waste of money. So fee-free. And if it's for your future me or emergency fund, if it's paying interest, and what are the conditions? Like, is it a bonus interest structure? Do you need to be contributing a certain amount? Those are my 2 rules of thumb for them. And we've just got a little example here, putting into practice the 50-30-20 rule. So if you were earning $5,000 a month, then 50% would be $2,500 going to living, $1,500 for fun money, $1,000 going towards goals, assuming that emergency fund's already set up and it's got a balance of about $7,500, which is your 3 to 6 months. Alrighty. Cool. Okay. Now, what constitutes living expenses? Just going to dive into it quickly. So living expenses is your bills, insurance, gym memberships. I prioritize my Glam Corner subscription because it's important to me. You can put hair, self-care, things like that. Netflix, says Heidi. Yes, all of the above. Regular recurring expenses that you kind of have to pay. Now, if going through your bank accounts and figuring this out absolutely reeks of effort, you can use a budgeting app, WeMoney or FooPay. There's heaps out there, Money Brilliant, Pocketbook, list goes on. But there's some great budgeting apps out there. Little helpful tool to make a little bit of extra money or make sure that you're spending your money efficiently is Shopfully, and they'll show you where there's deals and specials on. And then if you've got to do your groceries or got to do certain shopping, all the time anyway, some great tools is using shopping platforms like Cashback or Shopback, where doing your everyday shopping actually becomes rewarding because you get cash back into your account. Alrighty, cool. So we're just flying through. I'm loving all the questions in the chat as well. Thanks everyone for that. So step number 3 is getting rid of the bad debts in your lives. We don't like them. We don't want them hanging around. So step 3, get me out of here. See what we did there. So little quiz, pop it in the chat. If you put $2,500 on a credit card and that credit card has the average interest rate of 19%, yikes, it's hoi. How long will it take you to pay it off if you are just paying the minimum repayment? Is it A, 1 year, B, 5 years, or C, over 30 years? Just pop some guesses in there. C, B, C. Yeah. Oh, yes. Good. All right. So mostly everyone's saying B or C, but which is it? That is the question. Oops. And that's when my Google stopped working. There we go. The answer is C. So over 38 years, it will take you to pay off. I was actually coaching a client a few weeks back. She had a $15,000 credit card debt and was just paying the minimum repayment, which was about, I think it was like 250, bucks a month. And, rightly, like many of us, she just thought, oh yeah, I'll just pay the minimum because that's the repayment plan, not realizing that really it's just servicing the interest. And I showed her that by continuing to do that, it would take her 58 years to pay off her credit card, and it would cost her about $75,000 in interest. And if she simply doubled it, she would pay it off in 2 years, doubled the repayment. And if she tripled it, she'd pay it off in 1 year and obviously save a lot in interest. So needless to say, she changed the repayment amount. Now, to pay off debt, I'll just quickly explain what is good debt, what's bad debt, because not all debt is bad. So good debt is money that you've borrowed to buy something that increases in value. So things that typically fall under this category is education, buying property, or buying investments like shares. And the characteristics of good debt is that it's often very low in terms of the interest that you're paying, so the rent on the money. And when you buy the asset, education, stuff like that, it increases in value over time. So the house goes up over time, or the shares go up over time. Education, obviously a little bit different, but the view is that if you're spending money on educating yourself, that should increase your income potential. So, overall, it's a good investment. Bad debt, however, is any money that you've borrowed to buy something that goes down in value over time, or often referred to as liabilities. So, it's probably money borrowed for a car, for going out, for traveling, for buying white goods. I usually say, you drank it, you wore it, you went there, you consumed it in some way. And typically the interest rate on your bad debt is above 10%, which is quite high. So any borrowings that you have, typically like credit cards, personal loans, maybe buy now, pay later accounts that have high interest rates or really high fee structures, those constitute your bad debts, and they're the ones you want to prioritize paying off. Now, how do you pay them off? Well, there's two very popular methods. Molly and I did not come up with these. They're tried, they're true, they're tested, and widely used around the world. The snowball method and the avalanche method. The snowball method basically says that you write out all your debts from smallest to largest and work to pay them off from smallest, then the next one, then the next one, until you hit the largest debt. The avalanche method is that you pay off your highest interest debt and move through it, next one, next one, next one. So tackling whatever costs the most first. We are big fans of the snowball method, so we're just going to break this one down over the next couple of slides. And there's also some pages in your workbook that will reference this as well, so be sure to check that out. But step one of the snowball method, super quick and easy, list all your debts from the smallest amount owing to the largest. Make sure you write down, what's the balance of this debt, what's the interest rate, and how much do I need to make as a minimum repayment. Step number two, remove temptation. So if it's a credit card, we're going to be chopping it up, popping it in a bowl of water, putting it in the freezer. If your credit card details are like saved to the checkout, like how you save it on Google, or you save it on your Apple Wallet, or you save it with your favorite stores. I realized my credit card details were saved with a wine store the other day, obviously pre-baby, but oops. So unsubscribe, unsave those ones, so that you remove the temptation to keep spending. Now, if you've got a few different debts, what you can often do is actually negotiate to get a better rate on them so that you're paying less money in the interim while you're working to pay them off. So a couple of negotiation tips is, before you call up your provider, do some research on competitors, know what other people in the market are offering, and then leverage this as a part of your negotiation, asking them to see if they can match it. Now, don't tell them what your preferred rate is, but ask them what's the best rate that they can offer you, simply because you don't want to reveal your cards too early. They might offer you a better rate than what you wanted. So put the onus on them to, secure your business and give you the great rate. If they can't adjust your interest rate, see if they can maybe waive some annual fees and save you money that way. Some hot tips. Okay, back to the snowball method. So step three, you've written them down, you've removed temptation, you've negotiated your rate. Now it's time to start paying them back. So make sure that you're paying the minimum repayment across all of the loans. And then any surplus cash you have, direct that to paying off the smallest amount possible, so the smallest loan. And then keep doing that until it's paid off. Then once you've paid off that first loan, have a little celebration, start paying off the second one. Now, another tip to look at is see if, we've talked about negotiating the lower rate, there's also balance transfers. The only risk with the balance transfer is that they often lend you more money than what you currently owe to do the balance transfer. So just make sure that you don't get tempted to spend and increase the debt. So paying it off, and then keep going, rinse and repeat until you've paid off all your debts, and then you, my friend, will be debt-free. It's a very happy day when that one happens. Cool. All right, nearly halfway through. Tax time. Which tax bracket do we all fall under? Now, tax time, a lot of us eyes glaze over, roll our eyes, get upset. Why are we paying so much tax? It is a pretty high tax environment here in Australia, particularly if you do earn. Liz says tax time is the worst. I feel you, Liz. But think of it as like a yearly subscription to live in Australia, and childhood's like the free version that we all got. But then now the trial period's over and we've all got to pay our subscription fees. So working out how much tax you're going to have to pay. So please refer to your workbook. There's a great little tool in there. Now we've got the sort of tax rates. Now the interesting thing is that, say you're earning 120,000, then you don't just pay that flat rate of 37% across everything you earn. It's a tiered thing. So, for the first 18,000, you don't pay any tax. From 18 to 45, you're paying 19 cents on the dollar. From 45 beyond, it's 32.5 cents. So there's a little exercise in your workbook to figure out at 80,000, what would you be paying in tax? We also don't forget the Medicare levy as well. Okay, so I'm going to assume everyone's going to do that little exercise. If you're like, I don't want to do the exercise, Betsy, there are tax calculators available online. You could use that as well. Okay, how do I legally pay less tax? Well, here's 5 ways that you can do it. So the first is through salary sacrifice. What is that? Basically, you've got your gross income. So say your gross income's 100,000, and then once tax is taken out, it drops down to 70 something. By salary sacrificing, you're basically spending some of your gross income ahead of time, so that what gets calculated as your gross income for tax purposes is lower, and you often save tax. So examples of salary sacrificing might be making additional contributions to your super fund. It could be paying, there's a bunch that you can do. You can salary sacrifice. It depends on your employer. Things like education, sometimes investment loans, could be cars, things like that. So have a chat to your employer as to what is available for you to salary sacrifice, and you can set that up directly with them. But essentially, say again, using the 100,000 example, you're earning 100,000 and you're going to sacrifice 10,000 and put that into your super fund so that you're topping up super. Then when they calculate how much tax you need to pay, it's based on 90,000. So overall, you pay less tax on 90,000 than you do 100. So that's how you make the tax savings. Chat to an accountant around how to do this, or get professional advice. But that's in theory how it works. So we talked about topping up your super fund as another great way to save tax. Prepaying expenses. So being able to prepay interest on an investment loan is an example of how you might be able to save tax as well. Of course, getting advice from a professional like an accountant on various tax strategies. Maybe there's deductions that are available to you because of your family structure, the place that you work, where you're living. So make sure that they talk to an accountant and find out what's available to you. And then number 5 is donating to charities that are registered as well. So anything over $2 that you donate to specifically registered charities will be available as a tax deduction. So that's always a nice one to sneak in just before tax time. It's a feel-good factor too. All right. Super savvy. Okay, I'm going to nerd out now and tell you all how much I love super. I call it my future freedom fund. Why do I love it? Because it's the most efficient investment vehicle in Australia from a tax perspective. So you know how we were just talking about tax? So, say you're earning 80,000, you're paying roughly 32% tax, or 32 cents on the dollar. In super, all the money that you earn in super is only charged at 15 cents on the dollar, or 15% tax rate. So in terms of having a place to invest and for your wealth to grow, super is a fantastic one because you're only paying a low rate of tax. So more of the money you earn in super goes to compounding and growing your wealth over time. And then when you retire, that income is tax-free. So I love super. So superannuation, putting money away now for later. That's why I call it my future freedom fund, because one day I won't want to go to work and I would like to have a stockpile of cash that can replace my income. And that's what my super is all about. So it's super tax efficient, as I said, only a 15% tax rate. It's also good because it forces us to save money. I I mean, with the exception of the coronavirus, where we've all been able to pull out a little bit of money from super, typically once the money's in, you can't touch it until you reach that qualifying age, which is currently 65, although by the time most of us get there, it'll probably be like 67, perhaps more. So it's for savings, and the government did it because, you know, yes, there is the pension, but it's not a lot. It's about 24,000 for a single. And what we found is we weren't very good at saving this ourselves. So creating something that forced us to save meant that more of us can live an independent retirement. And the cool thing that happened this year is that the compulsory superannuation contributions that our employers make, the superannuation guarantee, that rate went up. It's currently at 10%. So 10% on top of your gross earnings is what goes into super. I'm also thrilled because when it was 9.5%, that was way harder to calculate, and 10% is much easier math for me, at least. But that's going to increase over the next few years all the way up to 12%. Now, how much do you need to have a comfortable retirement? This is very subjective. I'm just going to say it, because what's comfortable for one may, you know, feel like living like a pauper for another. But the Association of Super Funds Australia say to have a, you know, reasonable standard of living, an individual needs to retire with $545,000 in today's money, or for a couple, that's $640,000. There's some great calculators that you can use to show, are you on track with where you are now to hitting the equivalent of that amount. And again, if you hit up Ladies Finance Club, you'll see some great posts and information around this. So lots of info out there. Now, couple of hacks to help you boost your super fund. So first of all, make sure that you've only got one super fund, because if you've got more than one, you're possibly paying double sets of insurance, double sets of fees. Nope. Have one, pick one horse and back it. So see if you've got more than one, and you can do that by logging into MyGov and heading to the ATO section and entering your tax file number, and that'll bring up all the super funds under your name. You can also search to see if you have any lost super. So when I was much younger, I did a couple of stints at different cafes, and every different cafe I worked for opened up a different super fund. So when I first did this, I realized that, oh, I had a few accounts. There wasn't much left in them by the time I found them, but there was some money floating around, and it's your money. So, you know, invest the 15, 20 minutes to go find it and reclaim it. So we've got the Your Super, which is, you can look on MyGov and see stuff about your super. There's also, so we talked about those shopping platforms earlier, but Super Rewards is a shopping platform where you get cash back on your everyday purchases, but it goes to your super fund rather than in your pocket. Because like me earning, you know, $16 cash back as cash is nice. I'll probably just spend it, but putting it into my super where it can compound and become something bigger, that excites me. Other ways to boost your super is obviously contributing more. Ladies, this is a really important one if you are planning to have a family. The average Australian lady takes 2 years off with, you know, parental leave, which, you know, based on the average Australian salary is about 16,000 that we miss out on in super contributions. But by the time we retire, that money is worth about 120,000 in our retirement balance. So, you know, one of the great things is to try and make additional contributions either before or after you take parental leave. You can also do spousal contributions where you and your partner split the contributions. So some goes to their fund and some goes to your fund to kind of make up for that lost super. The best employers are now making super contributions on top of your mat leave. Sadly, mine isn't, but there's some really great ones out there. So do check out with your employer as to what they offer as well. Now, they say cash is king. And Molly, how are we going on the questions? Is there anything I should be answering? Because I'm just rolling through.
Yeah, no, we've only got about 10 minutes left. So I
We'll
think
keep rolling through.
we might keep rolling if that's all right.
Boom. Yeah, that is good. Thank you. So they say cash is king, but Actually, not always. So let's say you had $10,000 in 1995. What would happen if you A, left it under the bed, B, invested it in the bank, or C, invested it in an asset that was growing? So let's say like Australian shares. So if you just left it under the bed, you'd still have $10,000 today between now and 1995. If you invested in the bank, you might have as much as 30,000 through compounded interest. But if you invested it in shares where it was earning a much higher rate of return through dividends and capital growth, that $10,000 would actually be worth close to $75,116 simply through compound return. So what is a compound return? And we're going to go much more into the detail on this in the investing workshop. But effectively, you got $100 and it earns 10%. And instead of spending that 10%, you add it to the $100 and invest it again. 110, another 10%, you earn 11, combine it, invest it again, and so on and so forth. And what starts out small over time really snowballs and becomes quite a significant return. So, would you like $1 million? I'm going to assume yes. What do you need to be investing today in order to have $1 million in the future? And we're going to assume that you're investing it in something that returns at least 6% per annum as an income. So if you were, say, 20 years old today and you want to have $1 million by the time you hit 60, then you need to be investing $525 a month. If you want to have, I'm just using this 20-year-old example for easy math for me. If you want to have $1 million at age 55, then it's $729 you need to be investing today. If you want to have $1 million at age 50, $1,027. At age 45, $1,479. And at age 40, $2,206. Now, what that hopefully is highlighting to you is the importance of getting started with investing and doing it early, because you only need to invest a little bit to create really powerful returns. So the sooner you get started, the better. Okay, I'm sure there's a lot of homeowners on the line. Let us share with you a couple of tips on how to cut years off your mortgage. So, first of all, anytime you get some extra cash, either through like a tax return or a bonus, 100% have a think about putting that extra money into your mortgage so that you're paying less interest over time. One of my favorite hacks is actually, instead of doing a monthly repayment as it's often contracted as, simply switch that to fortnightly. Divide your monthly repayment by 2, pay it fortnightly, and you can literally save years and tens of thousands of dollars of interest simply by doing that. An offset account is another great tool for saving money. So instead of putting your money in a savings account where it might earn 1 or 2% interest, leave it in your offset account, and therefore you're only paying interest on the net amount of the balance of your loan and what's in the offset account. So you're paying less interest. And typically the interest rate on your loan is going to be much higher than the interest you earn on a savings account. And of course, if you have the free cash flow available, try and make extra repayments. My husband and I have been doing that lately. We try and do 1.5 times our contracted repayment to really pay that loan off quicker. And there's some great calculators that will show you how many years and how much interest you save by doing that. So let's use an example of just paying off an extra $20 a month. If you had a $500,000 loan and it had a 2.5% interest rate, by just adding that extra $50 a week, $200 a month, you would save $30,039 in interest. You'd also have your loan paid off almost 4 years quicker. Pretty cool. Okay, last one. So we all know that life sometimes full of surprises. It could be a global pandemic, could be a job loss, it could be an unexpected diagnosis with an illness. And one of the questions we want to put to you today is, what is your biggest asset? Now, most of us will probably think our home, our car, our super fund, but it's actually you and your ability to earn income. Now, we might just think about income as, I earn $60,000, like, that's good money, but it's not heat. So do I really need to insure it? Maybe you earn $75,000. If you are 35 years old today and you've got another 20 years of working and you're earning 75,000, that income is worth $1.5 million. So, compared to other things that you might own, a $1.5 million asset's pretty chunky. So it's definitely worth insuring. So if you haven't already, do consider setting up income protection to replace your income in the event that you became too sick or too injured to go to work. Other ways to protect yourself is having a will in place. I know I'm going to be updating mine shortly. Nominating a beneficiary of your super fund. So your super fund doesn't automatically form part of your estate when you pass away. If you haven't nominated anyone, the super fund will follow a set of rules to figure out who gets your super. But what you can do to save them all that hassle is nominate a beneficiary to receive it. And you can even just nominate your will or your estate as the recipient of that one. And then number 3 is just check that you've got the right insurances in place. So income protection, total permanent disability, which is a protection in the event that you become too disabled to continue working. You get paid out a lump sum to support you and also make the lifestyle adjustments you need. Life insurance, probably should be called death insurance. But this one is a lump sum that's paid to your estate or to your beneficiaries to do things like pay out mortgages or, provide funds for education and so forth in the event you pass away. And then finally, there's trauma insurance, which is an insurance that in the event you get, you have a traumatic event, like a diagnosis of cancer or heart disease or something like that, it's a lump sum that's paid to you to help you cover your cost of living and also some of your medical expenses to get you back on track. Okay, I'm going to wrap up with some tools that we absolutely love, and then we're going to tackle some questions. So we love budgeting apps like Foo, WeMoney, and Finder, because who's got time for a spreadsheet? There's an app for that and it can do it for you, and they're pretty accurate. I know the Foo app is at least 95% accurate on its categorization. Cash rewards for getting cash back to your pocket. Super rewards for getting cash back to your super fund. Petrol Spy is a really good one for just quickly checking who's got the best rates on fuel before you fill up. And then Money Smart, we absolutely love. It's a government website with amazing money management tools. It's free, and because it's run by the government, ain't nobody trying to sell you anything, which we think is also great. And finally, Switch and Save. There's a lot of different websites out there that will help you find better deals on things like energy and gas. For example, energymadeeasy.gov.au is another great website. And obviously, we love Ladies Finance Club. Duh. So I'm going to stop there. Molly, over to you to field questions and also find out what's everyone's biggest takeaway today.
Yeah, look, we would love it if you could pop it in the chat. What was your biggest light bulb moment, or what was your biggest takeaway from today's session? Bets did a fabulous job at going through quite a lot of information. So if you are there and you're feeling a little overwhelmed and you're like, oh my God, where do I start? In the booklet, we really help you kind of take it step by step. And remember, build that emergency fund, set up those bank accounts, and then you can really start building strong financial foundations for yourself. Alrighty, so some of the takeaways was how much I would need to save $1 million, how to set up my bank accounts, pay my mortgage fortnightly rather than monthly, loving Betsy's analogies, and your energy is infectious. Yes, it is. The tax subscription to the country you live in, love that. 50-30-20 rule. Again, a lot of people were loving the mortgage hints and tips. We had a couple of questions come through. If you do have questions, pop them in the chat. However, one came up and it just said, could you just quickly talk over the super, how much you can contribute to your super? We did put it in the chat, the amount, but maybe just, Bets, if you wouldn't mind just going over that one.
Yeah, now it's just changed, and actually I'm gonna have to check.
It's 27,500.
27, yeah. I was like 25, 27 and a half, yeah, 27 and a half, isn't it? Is your maximum contribution. So there's the pre-tax contribution. So that's what your employer employer pays, and then what you want to put in up to that 27.5. Then there's non-concessional, which is like post-tax money, which I believe is now 110.
Yeah.
Or you could do up to 330, but then you can't do any for the next 2 years because it's capped for the 3 years. So those ones can be handy if you've got an inheritance or you've sold an asset or you want to put some extra into super. But yeah, always get advice from a suitably qualified professional as well.
Awesome. And please do connect with us. We're there we've got a Facebook group where we talk all things money. So it's Ladies Finance Club Money Chat. And then we're also on Instagram, and we constantly post helpful little practical tips, takeaways, tools, and share a whole bunch of stuff on our stories. And then just super quickly, if you want more, please check us out. We have investing courses. We've got lots of free online events if you really want to start making money a real center point in your life, or you can learn more about joining the LFC club. But thank you so much. And I think that was all the questions that came through. So
Yeah.
I'll hand back